In this training, we're covering business lines of credit. A business line of credit is a revolving credit facility designed for ongoing business needs. Unlike a term loan, the borrower does not receive all funds up front. Instead, they draw funds as needed and only pay interest on the amount that's actually used. Lines of credit are commonly used for working capital, cash flow smoothing, and short-term operational needs. Because this is a revolving product, it is underwritten differently than term loans, and lenders place a strong emphasis on sustainability and responsible usage. A business line of credit is best suited for established operating businesses. Lenders look for consistent and predictable cash flow because the borrower may draw and repay funds multiple times. This product is not designed for one-time purchases or short-term events. Strong business banking behavior is critical, and owners are expected to be actively involved in managing the company's finances and day-to-day operations. Underwriting for a line of credit focuses on cash flow sustainability over time. Bank statements remain the primary underwriting document, but lenders also evaluate exposure and utilization risk. Because this is a revolving credit, underwriters are asking whether the business can responsibly access and repay funds on an ongoing basis. Credit supports the file, but it does not replace cash flow. As with other cash flow products, consistency is more important than peak revenue months. Required documents for a business line of credit are similar to other cash flow-based products. This includes government-issued identification for required owners and business formation of EIN documents. Business bank statements are always required, and accounts receivable aging may be requested depending on the business model. Tax returns are only submitted when specifically requested by underwriting and should not be uploaded automatically. Bank statement requirements are critical for lines of credit. Statements must be complete and consecutive, with no missing pages or gaps in date ranges. NSF activity and negative balances are reviewed closely because they indicate cash flow stress. Deposit consistency is heavily weighted, and unexplained validity will raise concerns. If the business is seasonal, that seasonality must be disclosed upfront to avoid delays during underwriting. The most common decline and delay reasons for lines of credit related to risk management: erratic cash flow patterns, high existing leverage, or frequent NSF activity are major red flags. Inconsistent business information across documents will slow the review process. Incomplete or altered bank statements are often rejected outright, regardless of the borrower's overall profile. There are several items that should never be submitted for a line of credit. Do not upload screenshots instead of full PDF statements. Do not submit partial or cropped bank statements. Password-protected documents are not acceptable. Placeholder or estimated figures should never be used. Submitting incomplete packages will delay underwriting immediately. All business line of credit files must be submitted through the Four Corner Holdings platform. Begin by navigating to Clients and selecting Edit Client. Fully complete the Client Info tab and the Business Financials tab, as missing information will stall review. Next, mark applicable items in the document checklist and upload all documents in the Documents tab. It's critical that the correct document type is selected for each upload. Files are not reviewed until all required steps are completed. Once a complete file is submitted, it enters intake review to confirm completeness. Underwriting then evaluates cash flow, exposure, and utilization risk. If additional clarification or documentation is needed, underwriting conditions will be issued. The borrower responds inside the platform and the file is reviewed. At the end of the process, the file is approved, suspended pending items, or declined. Partners who are most successful with lines of credit follow a few best practices. They review bank statements before submissions and identify utilization or leverage concerns early. They coach borrowers on responsible uses expectations and submit only complete files. All documents, handling, and communication should take place inside the platform, not through email. A business line of credit is not appropriate in every situation. If the business has highly inconsistent or declining cash flow, is already over-leveraged, or only needs one-time capital, this product may not be a fit. Unstable banking behavior or borrower is unwilling to maintain financial discipline are also warning signs. In these cases, alternative funding strategies or preparation steps may be more appropriate.